But moving on from one stock to another, Cholamandalam investment is also in focus. We've got with us Mr. Vellayan Subbiah, who's the Managing Director at Cholamandalam Investment and Finance, joining in on the show. Welcome to the show, Mr. Subbiah. It certainly is a special day for us here at ET Now, celebrating our 6 years, and we're so glad to have you.
No, congratulations. I think ET Now has had a phenomenal run, and you've done a fantastic job kind of bringing coverage to the whole business segment in India. So I'd like to just say congratulations to ET Now. It's been a great 6 years and looking forward to a lot more great stuff from you.
Thank you so much for those kind words. Now, to start off with, we've got some brokerages such as UBS. They've said that your company is the key beneficiary of recovery in the LCV cycle. Are you seeing signs of a pickup?
Yes, so traditionally LCVs tend to lag MNHCVs in terms of a pickup, right? So what we've seen is the pickup begin to happen in the MNHCV side. So we definitely expect it to happen in LCVs, likely in the second half of this year, and that's our expectation at this point.
Now, so far we've seen weak rural demand at the ground level. What's your view when it comes to demand in rural markets and the impact of monsoon as well on your cash flow of customers?
Yeah, it's really too early to tell, and usually what happens in the trucking business is that the monsoons is usually not a great time for us, just because, road transportation does get affected by the fact that, the heavy rains do affect it quite significantly. So usually we need to see how the monsoons play out, and I think it's too early for us to predict that. Obviously the Met and kind of other departments are much more successful at predicting those kinds of things than we are. So we're only going to be able to see that after the monsoons actually play out and we see what impact that's had on the ground for farmers across the country, and that obviously kind of has significant impact then on the rural demand as well. So I think it's a bit too early to tell. We've not seen any uptick yet, and we'll have to wait till the monsoons are done first before we react.
Now, you also have presence in the trucks as well as SME segments. Are you seeing improving collections? How do you see the overall trend in credit demand and asset quality shaping up in both these segments?
So definitely, my belief is that the worst is behind us. Right now, the question is how quickly is it going to get better, and how much better is it going to get? Now, I'm not a great predictor of that. What we do see from our own data is that collections have gotten better. And but I do think that has been both a combination of the extremely intensive efforts we've put in with some actual kind of pickup in terms of performance on the ground as well. So how quickly this turns into real growth in credit demand still remains to be seen. What we basically see broadly is that there's a combination of three factors at play here. One is an improvement in collections performance. The second is hopefully kind of a reduction in borrowing costs that play out with both decreasing base rate environments plus availability of more money market instruments. And then the third is an actual uptick in demand. Now, our belief is that if at least two of those three factors play out, this year will turn out to be a much stronger year than last year. And our belief is that two of those three factors will play out. Now, which two it's going to be and when, I think is a bit, it's difficult for us to predict.
And finally, most of the banks have also started cutting rates. Will you be passing on the benefit to borrowers and cut yields? And in light of that, what's the view on your margins?
See, what we're seeing in the industry is that most people are not cutting yields yet, especially because, the overall NIMs, though they've remained steady, a lot of that gain has been eaten up by the increased losses in the environment. So I do think that this trend is going to continue, which is the NIMs and the yields will continue to the NIMs might actually expand a bit because the yields will continue to kind of remain at the current level. Just because some of that gain is getting eaten by the exacerbated losses in the business. So my sense is that yields will not drop even if cost of funds and banks begin to kind of drop rates, at least in the immediate future. That's especially true on the vehicle finance side. On the home equity side, we see an almost immediate transfer. So when cost of funds do drop, we do see yields beginning to drop in that business.
Okay, we'll leave it at that. Thank you so much for joining in and giving us a view on how business is shaping up and how you stand to benefit from the recovery in the CV cycle as well. The stock clutching onto that level of 600 as we speak. And Going okay for the rest of the market, 8,071, and clearly, as I flagged off, it's the broader end of the market that's looking super robust. And in fact, let's bring on board our technical experts as well to find out their top ideas. And Sandeep, run us through your top recommendations.